8 steps for portfolio management. Hi, my name is Anuj Gupta, your strategic wealth consultant from Tag Investments. Today we're going to discuss about the success mantra for portfolio management in 8 steps. Yes, you heard it correct. Within 8 steps, you'll learn how to manage your portfolio like a pro. So let us get started. So the first thing what you need to consider while actually making a portfolio and managing a portfolio is the EIC formula. So this is a very famous formula written in many books, and we have just consolidated all the thoughts and all the best criterias which you should be following for portfolio management in these 8 steps. So the first step being EIC, economy, industry, company. So whenever you are investing, you should always look at the economic conditions, the best suited industry in which you are investing in, and then comes the company. So when we say economy, so you have to look at the micro and macro factors of economy. What's the balance sheet of individuals? What's the balance sheet of the government and the institutions at large, by and large? How is the economy in terms of GDP growth doing? Second, industry. In a bad economy or in a healthy economy, there will be few sectors which are doing bad and good, and vice versa. So you have to pick up the right sectors, right industry which are doing good at a given point of time. And then once you have understood which industry, say for example pharma, say for example IT, healthcare, hospitality, aviation, chemicals, so on and so forth. So if whichever sector and industry you feel is doing good as per the statistics and research, there are ample number of research reports available in the on the internet, and with the advisor or at an individual level, you can actually find out which sectors and industries are doing well. Once you have found out which industry is doing well, then you need to further drill down to specific companies. So within the aviation sector, which airlines is doing well? Within the chemical space, which industry, which company is doing well? So on and so forth. And then you have to buy or purchase that one or two shares out of the entire universe. So that's the first step. Second, you need to understand the difference between strategic asset allocation and tactical asset allocation. So strategic asset allocation talks about goal-based investing. So you have to divide your money between goal-based investing, which is strategic asset allocation, and second, tactical asset allocation, which is view-based. So view-based can be for short-term, mid-term, long-term, depending on the view or depending on the horizon of investment. And strategical asset allocation always talks about goal-based, which can again be short-term, mid-term, and long-term in nature. Something like short-term can be buying a car, buying a house. If you are already in your 40s, 50s, and you had a dream of purchasing a house and you've created a good amount of corpus, so that can be a short-term goal. A mid-term goal can be a renovation of house, quitting a job, starting your own. If you are into service, starting your own business. It can be your children's education. Higher studies, if you have children who are middle aged, like 5, 10, 15 years, so that can be your mid-term goals. Long-term goals can be retirement, to start up your own business, to start up your own professional work, once in case if you are into service. It can be your children's marriage, children's education. So all those can come and be a part of your strategical asset allocation. The tactical asset allocation is mainly view based in terms of whichever sector, industry, company, basis on the economy, whatever is doing well, we take the call on that view, and then do the asset allocation in a tactical asset allocation manner. So you should be dividing your money into two: strategic asset allocation and tactical asset allocation. So our view would be that something 70-80% should go into the strategic asset allocation, and 20-30% should go into tactical asset allocation. The third is investing and trading. So something very similar, that again, if you have 100 rupees to spare for your portfolio building, portfolio management, so 70-80% should be into investing, and 20-30% should be in the trading criteria. Always keep investing and trading at an arm's distance, and do not mix both of them. Fourth, always have a large cap, small cap, and mid cap portfolio. So portfolio mix would be 50% large cap, 30% mid cap, and 20% small cap. That should be the asset allocation for a good portfolio. Now one should know what is value investing, growth investing, contra view. So value investing is basically something which talks about where the intrinsic value over the base value of the stock or mutual funds or the underlying asset is cheaply valued as compared to its fair value, or whatever earlier the price was, it has dipped down, and in terms of its P, price to earning ratio, it has come down. So that is value investing. Growth investing is for already those set of underlying assets or stocks which have already given good returns. They have high valuations, but they are market leaders and they are performing well. So that is growth investing. Although their valuations can be high, but we still continue to invest. Contra view basically talks about those sectors or those underlying assets which are actually not working in the present times, but which may have a future in the in the times to come. When I say in the they might have a good performance, or they might give good performance in the future. So that is contra view. So example, in the lockdown, aviation sector, entertainment sector was in complete lockdown. So one could buy airlines shares, one could buy stocks like PVR and have a contra view and hold on to them for a healthy gain. Next is the rule of 33 is to 33 is to 33. This talks about that if you hold 10 stocks, so 3 of them will always be underperformers, which will eat up you can say growth in your portfolio. 33%, 3 odd stocks out of 10 will be no profit, no loss. They'll always be static. And 3 out of those 10 stocks will be multi-baggers, will be outperforming stocks for you. So you should always remember that not all stocks which you buy or not all investments which you do will be fruitful. Next is that again have a healthy mix of mutual funds and stocks. So there's a debate, and we've already made a video whether we should be whether you should be investing in mutual funds or stock. But the right answer for portfolio management is that you should have a mix of mutual funds and equity both in your portfolio. So something like a 80% mutual fund and 20% equity is a good mix. Last step is that you should understand what is the difference between good debt and bad debt. So many a times we get leverage in terms of margin money. We take leverage to participate in the market. So that is not a very good habit in terms of taking leverage or taking loan to participate in the market, like equity or stocks. At the same time, when we talk about good debt, it can be like taking a home loan, and you're taking tax benefits out of it, and you are able to leverage, or you're able to make an opportunity out of the loan which you have taken. Similarly, if you are in terms of margin money, if you are taking leverage and you know that okay fine, it's a calculated bet and you are not over leveraging yourself, so that also comes under good debt. So you should always differentiate between good debt and bad debt. So to sum it up, these were the 8 steps for portfolio management. I'm sure that if you follow these 8 steps, then you need not actually understand what is fundamental analysis. You don't need to understand what is technical analysis, and you can just simply be a wealth creator for you and your family in the times to come. So thank you so much for the watch. In case if you wish to get onto a 15-minute strategy call with us, we usually leave a 15-minute Calendly link in the description and comment box, so you can set up a meeting with us and our wealth experts, and we'll be happy to help you in any of your queries. In case if you have not subscribed our channel, we request you to subscribe our channel to keep hearing us and to keep viewing us and to keep getting informational videos such as this one. Thank you so much once again. Have a fruitful year ahead and a happy financial life. Thank you so much.